glad to have Eric here. Eric Pally, managing partner from Founders Collective, one of the leading early stage funds. And let me just see here. We'll probably go for give it another minute or two. And maybe before we start, if you don't know Venture Lane yet, Venture Lane is the leading startup hub for early stage B2B software companies here in Boston. We're about 2 years old. We have as you see here in the background, that is a picture that's part of our space. We're in downtown Crossing. And what we do is we really curate companies to come into our space and our community and help them along towards a Series A. So usually fast growing B2B companies that like and want a bit of support, join us. And we have about 30 companies in so far from all walks of life and different industries. We don't do hardware, we don't do life sciences. So we really do we focus on software and B2B. And as we hit 12:04, I would say we officially start and begin. Eric, very, very, very pleased to have you on board. When I reached out, I told you, man, I don't know, somehow I must have missed you and Founders Collective for a year or 1.5 years, because somehow our path never crossed really. So I'm really happy to have you on board with as managing partner of Founders Collective, who I heard many, many, many good things about it. And today we're going to discuss is, when does venture capital become toxic for startups? So seems to be a very unusual topic to discuss with a VC firm. I'm even more happy to discuss this serious topic with Eric in a very honest way. But before we dive into this, Eric, can you tell us a little bit about yourself and what your background is and what made you become a VC?
Sure. So I was a 2-time founder right out of undergrad. Well, right out of undergrad, I spent 1 year in consulting and didn't consider it a very good use of time, and felt like I wanted to be doing something more challenging that actually used the brain instead of pretended to use the brain. And so I founded a company in New York a very long time ago, in 1999, that was in the web marketing space. And then the dot-com crash came, and I went from being very young as a CEO to thinking it'd be really good if I knew what I was doing. So I went to business school, where I would say I had an amazing experience, but they didn't teach me in a way that would make you feel like you know what you're doing as a CEO, because a lot of that just needs to be learned on the job. But it was a great experience, and I did learn a ton. And out of my second year of business school, I started a company with Mike Rosenblum. Our first investor was a guy named Dave Frankel. And we started a company called Brontes Technologies, which was a spin out of MIT and Harvard, but largely MIT, which was acquired by 3M a few years later. So was in the 3D imaging space and 3D printing space. And there's good cases about it over at MIT and at Harvard, if anyone's interested, but quite a long time ago. And so in 2009, I was still at 3M, building the Brontes business. And I teamed up again with our first investor, the guy I mentioned before, Dave Frankel, and Mike Rosenblum, who was my co-founder at Brontes. And we started with a few other folks, Founder Collective. So Dave and I were the full-time partners, and there were a handful of part-time partners, a model we maintain today. Mike came on board full-time a couple of years later, and we've been going ever since. So it's 12 years now that we've been doing VC. The idea was to build the fund that was, the mission is actually to be the most aligned fund for founders at the seed stage. Those words have not changed in 12 years. It's the exact same mission. The reason we went down that road was we noticed Dave as an angel investor was much more aligned to us than the subsequent venture capitalists who came in to invest in the company. And we spent a lot of time thinking about why. What was it about Dave that made him more aligned to us than those VCs? We came up with a few things. And ultimately, it morphed into a belief that we could actually provide a much more aligned and supported role in the venture ecosystem than any traditional venture capital fund could. We could replicate a lot of what was special about what Dave was doing with us, and we built the fund around that. And since then, we've things have gone very well. We're software investors primarily, but it can be software applied to all kinds of things, from robotics to healthcare to consumer to e-commerce. And we've been investors in well-known companies such as Uber, The Trade Desk, Coupang, which is one of our companies, went public last week, Airtable, in Boston here, Whoop, PillPack, Desktop Metal, Form Labs, Embark Veterinary. Anyway, that's a quick summary on us.
Awesome, love it. I think you guys have like a really incredible track record in terms of 12 years of investing, and the amount of great investments and great companies that came out of your pool of companies that you funded. What I find interesting is like Founders Collective already, like the name is a different take on being a VC firm, and you being what do you think makes you practically, like, where can you help differently than another VC firm?
So I think if you're an entrepreneur today, you hear the term founder friendly a lot. And what's funny about that is the idea that venture capitalists would ever not be founder friendly, right? Like that, just think about that for a minute. Like the people who fund founders would not be friendly to founders. But it was true in the sort of subsequent, in the previous era of entrepreneurship. When I was an entrepreneur, VCs weren't very friendly to founders. So I think there's been a sea change improvement, but a kind of funny one to think about. We think founder friendly is like a useful and positive intent, but it really is not that powerful. Like, it's good to have the intent to be founder friendly. Again, kind of hilarious to imagine not being. But we really designed the fund around structural alignment. So how do you actually align to the founder? So there are a few things we try to do to enable that. One is, everyone on our investment team has been in your shoes. We're all operators. We understand it. We're not the only ones like that, although a lot of venture capital doesn't look that way. A lot of people who are transactional, who are bankers, who are not builders. But that's just sort of a small ingredient. I think the bigger one is sort of an inside baseball financial concept, which is we design ourselves to be a very small fund intentionally. And we really are focused on investing at the seed stage. We're not a life cycle investor. Now, it's counterintuitive. When I was a venture capitalist, I thought having a life cycle investor was a good thing, meaning someone who would invest in our company round after round after round. And so to me, the idea back then of pro rata, the right to invest in future rounds, seemed like a good idea. The truth is, pro rata does not help founders at all. An investor having a right but no obligation to write a check in your subsequent rounds means they would only be invoking that right when you do not want their money. If you want their money, they don't need to assert any special rights, right? So it was very interesting, the challenge I had as a founder with all of my VC funds who were life cycle funds, which was they were always net buyers in my business and I was always a net seller of my business, meaning we were never aligned. I always had to convince them the business was doing really well, and I had to a little bit be very protective of our vulnerabilities for the things that concerned me about the company. Because if they didn't want to invest in a future round, given they had that right, that could create huge signal problems and undermine my ability to raise money. But the problem became, the second I had other interests to fund our company, they were very assertive about those rights, right? They deserved X, Y, and Z round. So I had to constantly be convincing them to invest. The second anyone else wanted to invest, that's when they wanted to invest. And that's endemic to our whole industry. So we just don't play that game, right? We make one deal with the founders at the beginning, and we dilute alongside them throughout the life cycle of their business.
Nice. Okay. Eric, before we go into the Q&A, I want to quickly give us some figures around the fund. What, how big is the fund? How many funds did you do already? What's the usual check size, and what are you looking for? And just very quickly, maybe in a minute.
So in Q4 of last year, we opened our fourth fund. The fourth fund is 85 million. So we've always tried to stay really small. We write checks that, if we're the lead investor, typically are $1 to $2 million, and we join a board. And if we're a participant, which we're also very happy to do, we'll write usually a $400,000 or $500,000 check. And then we say, if we do our job right, we'll be your favorite aunt or uncle, right? Meaning we really are there to be as supportive as we can be without adding burden or overhead to the business. And I think, most of our founders would say we do that quite well. We tend to make, I would say 15 to 20 investments a year. So we're quite an active fund.
Okay, no, sounds good. Now, I just wanted to remind everybody, use the chat board down here. If you have any questions, we'll do probably, next 20 minutes or so, some questions around the topic of, when does venture capital really become toxic? But obviously, we want to hear from you. If you have any questions, don't feel shy. Just put it into the chat, and we'll make use of it during the conversation or have a Q&A a little bit later on. So, Eric, I would love to hear from you. Like, when is venture capital actually the right way of capital for a young startup, and when is it not? When is it helpful and when is it not? Maybe can you give us a distinction here where you, and from your experience, see, going down that route that makes sense, going down that route that does not make sense?
Yeah. So the challenge is that it is helpful for almost every company to have access to capital. But that doesn't mean every company is well aligned to what venture capital is. So I think there's a very big gap, because I think the challenge is most companies would benefit from having some capital. But the model is actually very punishing if you're the wrong kind of company. And so the analogy that's often used, not my analogy, is that venture capital is rocket fuel. And if you put rocket fuel into a really nice car, so say you put rocket fuel into a BMW, you probably destroy the car, right? And so the question is what you're building a rocket? And I think one of the biggest challenges is everyone wants to believe what they're building is a rocket. But I think the idea that the consequence of putting rocket fuel in what you hope is a rocket, but you're not sure yet, could be catastrophic. Hopefully it helps people understand that just the desire to be a rocket is not necessarily a good reason to give up your whole future or your business. So I think you've got to figure out how to validate that this business really can be a rocket. And then at each stage of raising the money, you have to be validating the right things to justify the amount of capital you're getting, because people think of dilution as the financing round they're doing. It's not really true. The dilution is the burn rate relative to how much value is created. So if you're creating enormous value because you validated things really well and you invest in them and it just keeps returning more and more value, then you're really not diluting at all. You might give up a percent of your company, but it's all accretive value, right? You're
Is this what you
creating
call
value in your
capital?
business.
Is this what you call capital efficiency in the end? Like,
Right.
it's the right dance between, what do I have to offer, and is actually taking capital on board giving me the right output so that I can grow faster than if I didn't take the capital?
Totally. So I think a lot of people hear me talk about capital efficiency and think I don't think they should raise venture capital, or they should be raising very little venture capital. And when I talk about capital efficiency, Christian, it's exactly what you just said. It's much more about the capital you raised is based on validated testing that allows you to invest in scale and the right amount of capital to invest in that scale, so that you're creating very clear, high quality, long-term value for your business. And that could be billions of dollars that would justify that. Like, it doesn't need to be no capital or small amounts of capital. The question just is, how well is the formula working? Because when you get over your skis and the formula isn't working and you're investing heavily, usually that has irreparable harm to startup businesses. And I think founders, VCs don't mind causing irreparable harm to startups. It sounds funny or awful, but the reason they don't mind generally is they just want outlier outcomes. So if they destroy, I have a VC, very well-respected VC, who's a friend of mine, who said, we want to blow as many holes in the ground as we possibly can, force these companies to their limits quickly, and figure out who should just be a loss and we should write off, and who can really build something big. And I don't think founders should make that trade-off. I think that's like, it's a very disconnected, misaligned view of VCs who kind of think, well, if I get one business that becomes worth $50 billion, I don't care if the rest all wipe out. But for the founders, this is their only business, and they should care a lot about what happens to it. And again, that doesn't mean they don't want to build something really big. I'm involved in a company that's worth, I'm on the board, that's worth $35 billion today in the public markets, and we burned $6 million before going public. Now that's the extreme of capital efficiency. But I think when VCs say, well, go big or go home, I don't think that motto has anything to do with your likelihood of success. You don't have to go big or go home in order to build a huge business, but that mindset can destroy your business very quickly.
Okay, Eric, can you give us maybe a good example of somebody who took VC money who shouldn't have, and what the consequence was of that? And then maybe the positive example of somebody that was absolutely right and they played it right.
Let me start with the second one because it's a little bit easier. Well, I think there was an extreme and a limit that got carried away, and a lot of problems that came up over time. I actually think, I have a lot of people who challenge me with Uber, right? We were Uber investors. We did very well as investors in Uber. That, Eric, you preach capital efficiency. That was like the least capital efficient company of all time. And the reality is Uber was contribution margin positive in all of their early markets very quickly. So when you have a unit economic that's working, when you have validation, getting aggressive in going after more markets when they're repeating successfully over and over again makes a lot of sense. It makes even more sense when there really is a network effect and an early mover advantage in those markets, or a first mover advantage in those markets. And so I think Uber is actually a good example of, they needed extraordinary amounts of capital in order to become the company they did, and it was the right move, right? There are so many companies that I don't want to pick on anyone in particular who run out of steam. You hear the story of like, then we hit a wall, right? Companies often who raised a lot of money and then we hit a wall, and you hear those stories all the time. And what I would say is, like, companies don't all of a sudden hit a wall. What actually happens is they inefficiently use capital for a long enough period of time that nobody believes in the business anymore and wants to keep funneling that level of capital into that kind of burn rate to keep the business going. But usually what happens at that moment is people say, well, the business was stupid. The idea was dumb. Thing is, none of these businesses are really about ideas. Ideas are a good motivator for people to start businesses. They're a good reason for people to want to commit their time and their energy to something they're really compelled by. But I would say a lot of the best businesses of our time, the idea was nothing so special. And lots of great ideas never become good businesses, right? So think of it as like a minimally acceptable idea is necessary, but not sufficient. But the crazy thing is, when businesses fail, people just conclude the idea was lousy. And usually what actually happened was the business was capitalized ahead of its actual validation. And at some point, nobody wanted to write another check.
Yeah, it sometimes feels that also just the execution kind of gets out of hand. So the team sometimes not being able to cope with the amount of capital that they need to deploy and the growth that they need to show in order to get to the next round. The business might have been the right business maybe a year later, or maybe with another tweak here and there.
So Christian, I agree with you, but I think most people think more capital helps you through that problem. And in most cases, less capital helps you through that problem, right? I don't mean dwindling bank accounts don't help you through that problem, but when you haven't figured out as a team how to successfully execute yet, the last thing you want to do is be accelerating your burn. And that's what happens, right? When you raise a lot of money, you start accelerating, you accelerate through all your problems because you like the mindset, we're a growth company and we're going to make it go away and we're going to use capital to fix it. And we are very fond of saying capital has no insights. We even make stickers that say capital has no insights. Capital cannot fix your business. You certainly need a sufficient amount of capital. But another analogy we like to use is like, capital is what's in the gas tank, right? Your burn rate is how fast you consume it and leak it. But the question really is, how are you driving the car? And if you're driving the car well, right, like to the right place, you're going to get there, right? but and of course you need a sufficient amount. But if you drive the car very poorly, or let's say you drive the car in a way that doesn't justify the capital, the analogy breaks down a little bit here, you'll leak it all over the place, right? And you'll destroy a lot of value.
Yeah, no, I get it. Eric, you once wrote, VC kill more startups than slow adoption, technical debt, or co-founder infighting. Um, how do I navigate as a founder? Who is the right partner? What is the right capital structure? Are there a couple of formulas that you see that if you that give me a hint of like I should go after this, I should go after this? Where is it a good idea to take money from a venture capital firm, and when is it not a good? Are there any metrics that you would suggest? What have you seen in terms of metrics that suggest actually that is a good idea?
So a couple of things. A lot of the capital concerns I have really relate to Series A and beyond, right? I'm not usually talking about the difference between raising, 1.5 million and 2 million in your seed round, right? The other thing it applies to very clearly is how fast you burn it. But it also applies to the idea of, should I be raising venture capital at all? If you have a new kind of tennis ball company that makes really cool colored tennis balls, it's probably not a venture capital backed company. And if you venture capital back it, it probably won't be there 2 years later. But if you figure out how to get some friends and family money or a little bit of debt, or you have some capital of your own, you invest in that, who knows? You might actually build a really interesting tennis ball company, right? It's hard to get very specific because I think all companies are different and their needs are different. But what you're really looking for is to raise money based on what you have validated, not raise money to validate, right? You'd like to, as little as possible, raise money to validate things, and as much as possible, raise money because you validated things. And if you can keep the progress of the business somewhat ahead of the capital you're raising, as opposed to have the capital of the business be well out ahead of the progress, that's where companies get themselves in a lot of trouble. You get on this venture capital treadmill and you just can't get off. And every round you have to oversell what's happening at your business. And the easiest example I use to illustrate this is sales reps. You have 5 sales reps, none of whom are actually hitting an economic formula for success. But you view yourself as a growth business and you're telling your growth story, and you go raise a whole bunch of capital and you put a big number out for what you're supposed to achieve the next year. And so what do? You go double your sales force, right? And you come in, let's say 60% of plan. It's just not working. Still nobody's hitting their number. But what do? Well, you tell a story and you raise a lot more capital and you double the sales force again. And now you've doubled it twice, when what you really should have done both times was actually pull back, figure out how to get the economics of the sales force to work. By the way, the economics of almost every sales force gets worse over time, not better, because there's a diminishing return curve to putting capital against hiring salespeople, right? In terms of training them and finding the best people and doing all this stuff. So anyone who's done marketing sees this too, right? The incremental dollar spent on marketing is almost always less efficient than the dollar before. There's a diminishing return curve. And yet, same thing happens on the marketing side, is like, we're a growth business. We're going to double the spend. And so at some point, you've got to say, like, look, until our formula is working, we don't want to spend more money. Right now, that may mean we don't raise for a while, and that's challenging if you're almost out of money. But that's why I say, like, if you're burning capital that wasn't accruing clear value, you're damaging the future of your startup, because you could have rewound back to your first raise and made sure at every step you were clearly creating value that you could invest in. You validated that you can invest in growing and improving.
So what you're saying is, as a founder, I should always have a very clear view on what the ROI is of the capital that I took on, and whether actually that money is producing the value that later on hopefully gets me a better evaluation. So, but I need to have all the metrics always clear of how I spend my money, and if this is like my personal investment in a bank account or investment account, do I get the ROI that I actually need? Is that what you're saying?
I think that's very close. I'm always afraid to talk in absolutes. Like, so you will use some capital for testing, but testing doesn't need to be expensive. right? Like, I've given sales examples, marketing examples. I'll give you an engineering example because engineering is really tough. Like people say, well, I don't know what the payoff for these features is going to be when I'm investing in engineers, but I know there's a lot we want to do and I need a bigger engineering team. And I think the challenge is just to throw it back in the reverse is like, well, imagine for a moment you're building all of the wrong things, right? Like that's the lesson in the lean startup, right? When Eric Ries talks about his experience as a founder, is they spent tens of millions of dollars building all the wrong things. Actually, at some point, they threw up their hands and said, we need to completely change what we're doing, meaning every dollar that was invested was wrong. Now, I'm not saying companies can completely avoid that or there isn't a risk of that happening. But the challenge becomes like when you just keep investing, and you're not validating any of those things, it's likely at some point you're going to throw it all away. Right? How do you validate them as you go? Sometimes you have to serialize some of your development to make sure you're not developing in parallel 15 things, 14 of which are useless.
Scalability and repeatability.
Well, because that's the thing is once you get to something you can validate as scalable, you can invest like crazy. That's the whole idea, right? Let's get it. If it actually works. We say go slow to go fast, right? Like prove things and then go. I've got 2 companies in our portfolio that are in the neighborhood of 100 million ARR that took 5 years to get to their first million. You can't do that if you raise $10 million in your first 5 years. It sounds like you should be able to because now you have all this money, but it actually goes the other way. There's so much pressure to scale that you can't hold off on doing the validation steps you need. And both companies went slow, fast. Right? So they went 1 million, 5 million, 15 million, 30 million, right? Like those became very fast growth companies, but it was basically 0, 0, 0, 0, 0, 1 in terms of revenue growth. And so, but they also, they ran very, very diligently, one of them was like 4 people for the first 2.5 years. Mm-hmm. So, and it doesn't sound glamorous. And it's really fun when somebody says, a VC comes in and says, wow, this is amazing. You guys should take $10 million right now and start burning $500,000 a month. But you're the only grown-up. It sounds crazy because we're all older than the entrepreneurs in many cases, the VCs. But the only we always say this at Founder Collective, like there are no grown-ups. Well, I would say the only grown-ups are the founders because it doesn't matter what the VCs tell you. We have different interests, and we try not to at Founder Collective, but VCs in general have different interests, and you're the only adults who can own trusteeship for that success.
Mm-hmm. Eric, before I get to the Q&A section here, and guys, fill in your questions if you have them. Let me ask you one last question from my side, because this is about like when does venture capital become toxic? Now, getting the wrong investor or taking too much money is probably different, might be wrong, or maybe not the optimal way. But toxic is a whole different way. Toxic is it feels a bit like the death sentence sometimes. It becomes not just a negative, it becomes like the total opposite. It works against you. So how would you describe that, like, capital becomes toxic, and what do you do once you achieve that status and try to get out of this?
So the analogy I use, which is pretty brutal, is venture capital likes to inject steroids into babies, hoping they become Olympians. They don't care about the consequences of anything else. And they sit there and tell you your baby or you're a baby and your kid is going to become an Olympian. So we're going to do this thing to it that will probably have terrible consequences to your baby unless they become an Olympian, in which case, by the way, it will still, I guess the analogy breaks down there, but it will still have terrible consequences, or could still, but at least they'll be an Olympian, right? Maybe that's the divergence of the analogy. But the point is, the second the capital the burn rate really gets out ahead of what is really working and validated in the company, instead of it being useful, it becomes toxic. Steroids are toxic, right? When that capital, so what do you do the second that happens? The second that happens, you got to pull back. It is so hard. It requires so much discipline because you've got a board of people, usually your VCs, telling you, no, go. You'll figure it out. You'll use money to solve the problems. Why do VCs think money solves the problem? The answer is it's because it's all we got. We got very little else to offer. So we think it solves the problem. Money doesn't solve the problem. You need enough money, but money doesn't really solve the problem. And it's like claiming money creates happiness. Money doesn't create happiness. The complete absence of resources might create unhappiness. I think it's true for people too, right? But it's the thing we have to offer, right? And so when that thing is too much, which happens a lot, it's happening tremendously frequently right now, it does become toxic. And the biggest challenge is the only point at which most companies deal with that is when they're running out of money. And that's a very tough point because either you have to upsell the story again and raise even more and keep the story going, or you have to admit it didn't work, right? And then you have this whole sort of insecurity, like, what was I basically running a Ponzi scheme? Like, the founders feel so, did I mislead everybody? There's so much personal frailty in that moment that denial is the easiest thing to have for as long as possible.
So what you're saying more or less, like, once you lose, like I've seen this a bunch of times, like once you lose momentum, it's kind of really hard to get back. So do your homework before it gets to that point, obviously.
I think that's good, but I want to tweak it, which is money can make things look like momentum that really aren't. And so you spend more and more and more making it seem like you're not losing momentum, right? So it's like, how much force are you applying to move this, this boulder up a mountain, right? And as the force goes up, 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 the boulder might keep moving at the same rate, but the force is increasing, increasing, increasing just to keep it moving at the same rate, which makes someone on the other side of the boulder just think, oh, it's moving the same rate. It's doing just as well. And the whole point is to get the boulder rolling down the mountain, right? To get a system working that gets easier and easier and easier, not harder and harder and harder. It needs fewer and fewer resources, at least within each unit economic, rather than more and more resources. But the industry is not designed for that. What's that?
You want to see the progress, right? You don't want to like the endless stream of capital that's fueling the model rather than the other way around. So Eric, it's a good time to kind of move over to the questions. And Alexei, maybe and just quick questions as you come along. Eric, Alexei was questioning around what do you think about investing in marketplace projects. It's a bit more of a general question, but probably around Founders Collective. Are you guys looking into marketplaces? Is that something?
Oh, for sure. We do tons of marketplace type investments, broadly and narrowly defined, but we do a lot of marketplaces, and always interested in platforms that can add value to the way markets work. Always.
Okay, good, nice. Keith was asking, what level of detail are you looking for on use of funds and financial projections during a first meeting? What are the metrics that you're looking for, the information that you're looking for?
Honestly, we're not looking that deeply on use of funds. Like, we assume it depends what the company is. But for most software, if we're doing hardware, it might matter a lot more. For most software companies, use of funds is primarily about hiring talent to build the product and push it into the market. So we'd love for the founder to show they've given a little bit of thinking there, but it's not a place where we spend a lot of energy or scrutiny. We're much more interested in how long they think the capital will last them, where they will be by the time they're done with that set of capital, what milestones they think they can prove, who's on the team, obviously, and what market they're going after. And frankly, how well they've engaged the go-to-market. And I don't mean like they're scaling up. I just mean like their thoughtfulness about what's involved in the go-to-market.
How much do you care about a 3-year plan?
Enough to glance at it and not enough to spend a lot of time scrutinizing it.
Okay, so it's just another information that kind of gives you, okay, do they do the right job? Do the metrics align, like in terms of sales growth?
And if we decide to go there, like, can we have an interesting conversation about it? Because like mostly what we're trying to understand is how the founder thinks, more so than this plan is going to be real.
Okay, got it. Jay is asking, he loves your founder-centric ethos. what are other firms that actually embrace that too? I mean, I don't know if it's well, I'm sure there's and I know a bunch of them here in Boston. Who do you think here in Boston does a good job in being founder centric too?
I love Jay's founder ethos. I know Jay for a long time. He's actually one of the first entrepreneurs who ever pitched me. Um, I think there are a number of very good funds here in Boston. I don't think they focus as much on how to align themselves to the founders as we do, but they certainly have very good intention and are really high quality work with. So, and there are many of them. I think at the very early stage, um, uh, Pillar and NextView and Hyperplane come to mind. At the stage after us, Spark and General Catalyst and Flybridge and CRV and those funds come to mind, and there are others too. And the thing I would say, and Jay knows this well too, is it's a mix between the values of the firm and the individual. And on the individual side, it's also chemistry. Like even among my partners, we definitely work from the same ethos and share the same values, but different people would have different chemistry with each of us. And so you kind of want to match that as best you can.
Yeah. And by the way, the firms that you mentioned, most of them we had here on Fastlane. So if you want to check out our blog, you'll probably see the summary or ask us for a link to the recording for that. Jennifer Wang was asking, what is exactly the dividing line between the seed round and the Series A? Where do you feel that, and again, like, what is a seed round and what is Series A obviously is a big question. I would say, like, here for Boston, where do you see that? When do I go for one versus when am I still the other?
Yeah, so these things have been moving quite a lot, because while it's true valuations have gone up a lot at each phase, what's really happened is the phases are later, or the metrics required or expected for the phase is getting later and later. So, what used to be called Series A here in Boston a decade ago is probably more of a seed today. And what used to be a seed a decade ago might have been more of a pre-seed, or might be today what we call more of a pre-seed. So in terms of dollar size and valuation and whatnot, so these things are constantly morphing. But I'd say in general, A's are a little later than they historically been. A lot of people used to say, for a SaaS, revenue is the easiest metric to think about, right? And that doesn't mean all companies should be valued in or thought about in revenue, but it is the easiest. I'm sorry, just turning off my alerts here because I didn't mean to disturb the conversation. So revenue is the easiest to talk about. I don't mean to put it all in revenue, but if you're a SaaS company, let's say, and you're talking about metrics, it used to be people would say you need $1 million ARR and you're good for an A. I think the reality now is like it's total table stakes and kind of minimal table stakes. Doesn't mean you couldn't raise a Series A with less or with that number, but I would say your probability of raising just because you're at $1 million ARR is relatively low, right? And so those numbers have gone up. The expectations have gone up because funds are bigger and bigger now, and the Series A check they want to write is $8 to $10 million, and so you figure pre-monies are starting to get to, depending on how big the round ends up being, 40 to 70 million or something. And so what traction is worthy of that? And frankly, a lot of Series A's are getting done at multiples that are amazing or just outrageous dollars, which, by the way, comes back to my concern about too much money too early, not enough validation. But I would say, today, if your revenue is less than a couple million ARR, you're most likely not ready for a Series A. But again, it's all over the place, and it's hard to give. It's a very good question because it's become extremely hard to give clear answers. The one other thing that's very interesting here is there's a huge amount of seed extension going on. So companies that do a seed round and then do another seed round, and then they do another seed round, and they do another seed round. So you see a lot of that pre-Series A to help the companies get to the point where they're compelling for a Series A.
I just wanted to say, like, it feels there's like is much more flexibility in a pre-Series A, in the pre-Series A rounds of like how it's called, how much money there is. a couple saves, bridges, and so on. So things that maybe 10 years ago, did not even exist to that point. So yeah, I think Series A's are kind of going up a little bit, but also the funding pre Series A is probably gone up too. We have Howard Bornstein here from InnoSpark. So he's asking, convincing founders and board that you need to slow down. That's a very tough switch. What do you do, or how do you have the conversation with the entrepreneur if and when it looks like the company of yours is spending too quickly getting ahead of its skis? So how do you have this conversation? Slow down. We invested in all of this. How do you have this conversation?
I try to have it as we start to accelerate. So we say, okay, getting back to a SaaS company. Okay, we think we're ready to expand the sales force. Why do we think that? What are the metrics we're going to look at to decide if it's still working? So it might be, well, our average rep is doing 40K a month of new ARR. And mathematically, when you look at that out into the future, it really works. The model really works. If we could stay above, pick a number 30 of new ARR, and I'm throwing numbers around, it all depends on the specific company, then it makes sense to keep expanding. And I say, okay, well, let's somehow put that down line in the sand that if we can stay above 30, it's good. So then you come back in 6 months later and you're like, okay, we're at 26. What do we do? It's like, oh, geez, was it just a tough month? Was it a tough quarter? We were above. Is it some new people not ramping as fast as we thought? Do we need to make some changes with those new people? How are the older people doing? And it gets very hard in that moment to say, well, we have this plan to keep expanding. We're a little short of where we want to be. Do we stop? And what I normally say in that point is like, your new hires, start thinking of them as backfills against the people who aren't performing, much more than thinking of them as new ads. Because again, you start keeping the people who aren't performing that well. And then you keep adding to them with more people who maybe aren't performing that well. And all of a sudden it keeps dropping. Well, 6 months later, you're at $22,000 of new ARR per rep per month, but the business is still growing. So you got a head of sales who is commissioned on overall revenue performance. The business is still growing. All he needs to do is keep adding more reps and the business is going to keep growing. I think as a board or as a CEO, you have to say time out. This isn't working. Right? So we're going to have to get rid of a bunch of our reps. We're going to have to take a look at how fast we're hiring. We might even need to stop hiring for a period of time. We've got to look at why the model isn't working. But what we cannot do is keep expanding that model. And I will tell you, because I've been on many of these conversations over the years, either as a board member or as an advisor to the CEO, when I'm not on the board, most companies keep going.
Mm-hmm. Okay.
And they destroy value, and they just don't fix it soon enough. They don't, because it's so, Howard's comment's right. It's so hard to put up your hands and say time out. It's so hard because all you want to be is that fast growth business, and you can make that boulder keep moving at the same rate by just increasing the force.
It's kind of you're on a drug, and like, how do you make sure that you're not
VC's
taking it anymore?
Don't overdose.
Yeah. We're slowly getting to the end of Fastlane. Ross is going to put in a link for our beta. VentureLane is actually launching a beta for VentureLane Connect, which is a platform that actually connects peers with peers and mentors and mentees, and there where we put all the the awesome content that we created for young startups together. So if you're interested and want to apply for our free beta that starts in the next couple of weeks here for the Boston Startup Ecosystem, go to that link and register. Eric, we have like a ton more questions. Would you be happy to stay 5 minutes more on?
Sure.
to answer some of those?
No problem.
So I would say, and I want to, before we go there, in general, some people have their next meeting. What is the best way to get in touch with you?
I'm Eric at Founder Collective.
Okay, so that's your email, or probably either Twitter or LinkedIn. And what is the best way if I want an investment from Founders Collective? Is this a warm intro? Yeah.
So 2 ways. One is you can email us cold, contact@foundercollective.com. I would say that is the inferior way. If you know somebody who thinks very highly of you, who knows us, that recommendation is very valuable. There are lots of interesting discussions that I agree with about how these types of network-based inbounds lead to sort of network homogeneity. And I hear that and I appreciate that, which is part of the reason we try to review every single thing that comes in cold. But I will emphasize that like it is very hard to judge a startup just from a deck or the bio of the founder. And having someone who knows you and thinks you're phenomenal, who knows us, say that you're phenomenal, it is very impactful. It's an unavoidable value add.
Yeah, and I think as just as a general takeaway, you know, having asked this question many times before, I think to add on this different layer of a third person that has a reputation in the market, but also know what they're talking about, I guess is worth gold all above when it comes to a first contact, right?
And I even go as far as like, we may not know them that well, but if we know them a little and they think you're phenomenal, please, that is helpful. Like we want to hear that.
Okay, good. I have some questions from Lucy and Sheila around women founders, and one is Lucy wanted to know what is the percentage of women-found businesses that got an investment from your funds?
Yeah, I need to look at our latest numbers. I would say overall our numbers are disappointing in my opinion. The percent we fund is much higher than the percent that comes inbound. So we clearly have a lot of work to do in top of funnel of attracting not just women, but people of color. I am pretty heartened though that over the last 2.5 years, my personal investing is more than 50% either woman or woman founder or person of color on the founding team. There are a few things I've been doing that I think have helped there, and I'm going to double down and continue to try to invest in those efforts. But there's a lot of work to be done in our industry, a huge amount of work to be done on this.
I agree. And this is, you know, Sheila is asking, you know, what's your recommendation or what recommendations you have specifically for women and BIPOC founders that have challenges fundraising at the seed stage and even more challenging towards a Series A? Any recommendations, any tips?
Well, first, I do want to acknowledge that like first fundraisings are really hard for almost everybody. They probably are harder. I would say they are harder the more sort of historic discrimination there is, and the fewer role models there are. So I do think it's really particularly challenging. But I want to acknowledge, like for everybody, I think first fundraisings, very few stories where they're not challenging. Given that they're even more challenging for certain groups, what I would say is a few things. One is you have to be very resilient. That may be an obvious comment, but you can't lose your confidence. You want to learn from the input you're getting, but not be impressionable, which is a sort of funny comment. But you want to basically take in the data and say, well, what do I think? Because I think for everyone, fundraising is very challenging. You get a million different data points, many of which are contradictory. And in that, you start to lose what you believe. And that never works. You can't fundraise by sort of satisfying the consensus. It very rarely works. So you got to believe in yourself. I would ask really hard questions to people you respect, like what are, you know, give me the toughest feedback you have about why you think I'm struggling to raise money here, right? It may be that you're running a business that isn't going to fit well in the venture market. You want to hear that, right? It might be that you're not bold enough in the way you're telling the story. It might be, but you got to go get that feedback. We really believe we do a lot of work with our seed stage companies to help prepare them for Series A, and you know they've all raised successful seed, but I would say many of them don't practice before they pitch. I think that's a mistake. They put together a deck that isn't that good. That's a mistake. You only get very limited opportunity to make a really strong impression. So you really got to use that opportunity well. VCs do this terrible thing. I think that's particularly bad for underrepresented groups, which is they say, no, put away the deck. Just talk to me. Just tell me what you think. And they do it so much that a lot of entrepreneurs walk in the room and they don't even take out a deck because they're like used to like, we'll just talk. And then you never get any money. And the reality is your chance of raising money if you just talk is so, so much lower. So do not get, if you can avoid it, do not get pulled into that. You can't fully resist if a VC says, no, 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 I don't want to look at any slides. You can't say, well, no, you have to. But what you can do is, like, if they ask you a tough question, you can say, you know, I have a slide on that. Let me pull that up, right? Like, I think it is really important to get the opportunity to tell your story. And I think all this informality lends itself to just bias, right? The more informal the meeting, the more it lends itself to bias. So you want to move away from that, not by being overly rigid in a way that makes the meeting awkward or doesn't give you the opportunity to establish rapport, but you got to lead, right? And you got to do the best to take that person through your journey in the most compelling way, which I would say, like, 95% of the time is walking, doing a really good job of walking them through your slides, because pictures are worth 1,000 words. And like, it is much more powerful.
Yeah, and maybe just one recommendation from our side, what we find is if you start pitching and you actually have 2, 3, 4, 5 people that are friendly to your, can give you that feedback, possibly even without needing or wanting to invest, but like they know what they're talking about. And having this, building this relationship with somebody that you can trust in, like, also do things wrong or maybe not the right way, and then tune it and then come back to it, that we found is super, super duper important at this early stage, where you're still refining your pitch and actually what might be the right narrative to tell then a hardcore VC firm.
I want to throw one more thought at that. I agree with that. And one more I'd say is, I do think at the end of the day, the people who raise, usually it's because they're much more resilient, rather than like it's some lightning in a bottle. Oh, they just easily raise money. Most founders who raise capital are unbelievably resilient. Like, I've seen founders pitch 70 VCs before finding the first one who says, yeah, I want to write a check. And then all of a sudden, everyone wants to write a check because somebody raised their hand. And like, you have to, you really do have to, like, go into the process knowing that it is going to be painful with a lot of rejection. We pitched about 40 VCs for Brontes years ago before anyone would write us a check. And then, of course, the second somebody wanted to write us a check, we had 3 term sheets. Right? There's this thing. So what does that mean? Were we not at all appealing the day before, or were we all of a sudden way more interesting the day after? Clearly not, right? But it's very challenging, and I think it is definitely particularly challenging for some groups to overcome. One, just the inertia of a process like this, and then also bias as well.
So thank you very much, Eric, for this candid interview and webinar, and sharing so many insights, which I really, really enjoyed your founder/investor perspective in a very honest way, and shared here with the group. Thanks for the gold nuggets that you threw in. I think, as just reading here the comments in the chat, a couple of people took quite a bit away. Again, sign up or submit your application for the beta if you want to have more content like this that kind of helps you through as a founder. Having a support group around you, be it your peers or be it with mentors in the Boston startup ecosystem. We'll be happy to have you. Eric, thank you very much for coming on board and doing the webinar. Good luck with spending your fund. All the best for 2021. Might it be fruitful and hopefully delivering what you think.
All right. Well, I wish everyone good health and much more extroverted days ahead.
Thanks so much. Everybody have a good day. Thanks.